January 29th, 2026, 8:30 a.m. New York time. Silver drops $15.20. Gold loses $500 in a single session. But here's what they're not telling you. At the exact same moment, in London, the price held steady. In Mumbai, no crash. In Shanghai, business as usual. The same metal, the same day, the same hour. But a $300 difference in a connected world where algorithms trade in milliseconds? How is this possible? Unless, welcome to Currency Archive. If you've spent decades building your business, protecting your wealth, and watching economic cycles repeat themselves, then you already know that markets don't just glitch by accident. Do us a favor, hit that subscribe button. Not because we're chasing numbers, but because this kind of analysis doesn't show up on the evening news. And drop a comment below. Tell us where you're watching from. New York, London, Mumbai, Singapore. Because geography matters now, more than it has in 50 years. Let's begin. On the morning of January 29th, 2026, experienced traders around the world opened their terminals expecting another routine session in the precious metals markets. What they witnessed instead was something that shouldn't exist in modern finance. At precisely 8:30 a.m. Eastern Time, the COMEX futures market in New York recorded a price collapse that defied every principle of efficient market theory. Silver plunged $15 per ounce in less than 20 minutes. Gold shed $500 in a single vertical descent that looked more like a system error than actual trading. Financial commentators immediately labeled it a correction. They called it profit-taking. They suggested nervous investors were simply cashing out after recent gains, but seasoned market participants knew better. Because while New York was experiencing this dramatic collapse, the rest of the world was watching something entirely different unfold. In London, the spot price of gold held firm at $2,558 per ounce. Traders at the London Bullion Market Association saw no panic, no mass liquidation, no emergency selling. In Mumbai, gold dealers were conducting business at $2,559. The physical market showed no distress whatsoever. In Shanghai, the benchmark price remained structurally stable. Chinese buyers continued their normal purchasing patterns without hesitation. The same asset, the same moment in time, but wildly different prices depending on which market a buyer accessed. New York showed gold at $2,222. London showed $2,558. That represents a spread of $336 per ounce. For context, in a properly functioning global market, price differences between major trading centers rarely exceed $5 to $10. Sophisticated computer algorithms are specifically designed to detect these tiny gaps and eliminate them within milliseconds through arbitrage trading. When gold is cheaper in one location, automated systems immediately buy it there and sell it where the price is higher. This process happens so fast that human traders never even see the opportunity. The price gap closes before anyone can blink. Yet on this particular morning, a $300 gap opened and stayed open. Hours passed. The divergence remained. This wasn't a momentary glitch. This was a sustained structural breakdown in how the global gold market operates. Business leaders tracking these developments recognized the significance immediately. A company treasurer in Frankfurt trying to hedge currency exposure couldn't determine which price was real. An electronics manufacturer in Taiwan planning to purchase silver for production faced a bizarre situation where futures contracts suggested one cost, while physical suppliers quoted something completely different. The situation recalled only two comparable historical events. During the 2008 financial crisis, temporary dislocations appeared between paper and physical markets. But those gaps closed within days as liquidity returned to the system. The maximum spread reached perhaps 12 to 15%, and only during the most extreme panic moments. In March 2020, when global markets seized during the initial pandemic lockdowns, similar divergences emerged. Again, they were temporary. Again, they resolved as normal trading resumed. But both of those episodes occurred during genuine systemic crises. Banks were failing in 2008. Countries were shutting down their entire economies in 2020. January 2026 presented no such emergency. No banks had collapsed. No governments had declared economic emergencies. No unexpected geopolitical event had shocked the system. Yet the divergence appeared anyway, and it persisted. Financial analysts began pulling historical data to understand the mechanics. In normal market conditions, the spread between New York and London gold prices averages $2 to $3. During periods of elevated volatility, it might reach $10 to $12 for brief moments. A sustained $300 gap had no precedent in modern electronic trading. The pattern suggested something beyond normal market forces. When prices fall everywhere simultaneously, it indicates genuine selling pressure. Investors worldwide are making independent decisions to exit their positions. Supply overwhelms demand. Prices adjust downward until equilibrium returns. But when prices fall sharply in one specific market while holding steady everywhere else, different dynamics are at work. This pattern indicates that the selling pressure exists in only one location. It suggests that participants in other markets either don't believe the lower price is legitimate, or they lack access to purchase at that price even if they wanted to. Physical gold dealers in Asia and the Middle East faced a straightforward test of the New York price. If they truly believed gold's value had dropped to $2,200, they would stop paying $2,500 for it. They didn't stop. Wholesale buyers continued normal operations. Premium levels remained consistent with historical patterns. Nobody was panicking to liquidate inventory. The physical market was calling New York's bluff, and that divergence contained a message that experienced business professionals understood immediately. Someone was manipulating the paper price. The question wasn't whether manipulation was occurring. The question was why, and what it meant for the broader financial system. The financial world operates on patterns. Experienced market participants develop an instinct for what normal looks like. They recognize the rhythm of genuine buying and selling. They understand how real investors behave under pressure. And they know immediately when something doesn't fit. January 29th, 2026 didn't fit. The collapse began at exactly 8:30 a.m. New York time. Not 8:29, not 8:31, precisely on the half-hour mark when U.S. economic data releases typically hit the wires. This timing wasn't coincidental. Algorithmic trading systems are programmed to react to scheduled announcements, employment figures, inflation data, manufacturing reports. These releases trigger pre-programmed responses from computer systems that dominate modern markets. But here's what made this morning different. No major economic data was scheduled for release at 8:30 a.m. that day. The calendar was empty. Yet the selling began anyway. At the exact moment when trading algorithms expect volatility, in the exact window when human oversight is minimal, during the precise minutes when liquidity is thinnest. Professional traders call this the ambush hour. It's the gap between Asian markets closing and European markets reaching full activity. New York futures trading is active, but physical market participants haven't arrived at their desks yet. The number of actual human beings watching screens and ready to respond is at its daily low point. Whoever initiated this sell-off understood market microstructure at an institutional level. The volume analysis revealed even more disturbing details. On an average trading day, COMEX gold futures see approximately 150,000 contracts change hands. Each contract represents 100 ounces of gold. The daily flow represents normal hedging activity, speculation, and legitimate commercial transactions. On January 29th, within the first 30 minutes of trading, over 400,000 contracts hit the market. Not spread throughout the day, not gradually building as news developed. 400,000 contracts dumped in 30 minutes. That represents 40 million ounces of gold. At $2,500 per ounce, someone was selling $100 billion worth of exposure in half an hour. No rational investor liquidates that kind of position in 30 minutes unless they're trying to lose money. Every professional trader knows that dumping massive positions quickly guarantees the worst possible execution price. Standard practice involves spreading large orders across hours or days to minimize market impact. But this seller wasn't trying to get the best price. They were trying to create maximum downward pressure. The forensic evidence pointed to coordinated naked short selling. This practice involves selling futures contracts without owning the underlying metal or having any intention of delivering physical gold if the contract reaches expiration. In essence, selling something you don't have to push the price down, knowing you'll never actually have to deliver. Here's where Executive Order 14346 enters the picture. Signed earlier in January 2026, this order restructured tariff treatments for various commodities. Buried in Annex 2 was a specific exemption for monetary metals crossing international borders. The exemption created a regulatory loophole. It allowed certain institutions to move paper claims on gold and silver between jurisdictions without the normal customs scrutiny applied to physical shipments. The practical effect was separating paper contract markets from physical delivery obligations. A futures trader in New York could sell unlimited contracts without proving they had access to physical metal. Meanwhile, a buyer in Shanghai wanting actual gold bars faced strict import documentation, delivery verification, and physical settlement requirements. Two completely different regulatory frameworks for the same asset. This split enabled the divergence. New York operated as a pure paper market where prices could be manipulated through contract volume alone. Shanghai operated as a physical market where every transaction required real metal changing hands. The institutional fingerprints on this operation weren't difficult to identify. Commodity Futures Trading Commission reports track large trader positions. The data shows which institutions hold significant short positions in precious metals futures. This information is public record, updated weekly. In the months leading up to January 29th, a concentrated group of 4 major financial institutions had steadily accumulated short positions, totaling over 600 million ounces of silver and 150 million ounces of gold. For perspective, total annual global gold mine production is approximately 100 million ounces. These institutions were short more gold than the entire world produces in 18 months. That's not hedging. That's not risk management. That's market control. The same institutions that held these massive short positions also serve as authorized participants in precious metals ETFs, act as market makers for futures contracts, and maintain clearing relationships that give them structural advantages in times of volatility. When prices drop suddenly, they can cover short positions at massive profits, while retail investors panic and sell at losses. The mechanism was clear: create artificial selling pressure through massive contract dumping, trigger algorithmic stop-loss orders, generate panic among retail holders, buy back short positions at deflated prices, collect the spread as profit. Meanwhile, 10,000 miles away in physical markets, none of this mattered. Because you can't eat a futures contract, and you can't put a paper claim in a vault. The divergence wasn't a mystery. It was the natural result of one market dealing in reality and another dealing in manipulation. While New York's paper market was collapsing, something remarkable was happening on the other side of the world. Nothing. Absolutely nothing. And in financial markets, sometimes nothing is the loudest signal of all. The Shanghai Gold Exchange opened for business on January 29th, exactly as it had every other day. Traders arrived at their desks, orders were processed, transactions settled. The machinery of the physical gold market continued operating without hesitation. But the price told a completely different story than New York. Shanghai showed gold trading at a $28 premium to the London spot price. Under normal circumstances, Shanghai typically trades within $2 to $5 of London. Sometimes it's slightly cheaper, sometimes slightly more expensive. The variations reflect shipping costs, import duties, and local supply-demand dynamics. A $28 premium is not normal. It's a statement. Chinese buyers were effectively announcing to the world that they did not recognize New York's prices as legitimate. They were willing to pay significantly more than the crashed COMEX quotes because they understood something fundamental. Paper promises are worthless if nobody honors them. The Shanghai Gold Exchange operates under a radically different structure than Western futures markets. Every contract requires physical settlement. There are no cash settlements, no rolling positions forward indefinitely, no naked short selling. When a trader buys gold in Shanghai, they receive allocated metal with serial numbers in a specific vault. When they sell, that exact metal transfers to the new owner. The system is designed to prevent the kind of paper manipulation that dominates Western markets. China's government tightened these requirements further in late 2025. New regulations prohibited foreign entities from selling Shanghai contracts without demonstrating physical metal ownership in approved Chinese vaults. The rule effectively blocked Western institutions from exporting their paper manipulation tactics into China's domestic market. This regulatory firewall explained why Shanghai didn't crash alongside New York. You can't dump 400,000 imaginary contracts into a market that requires real metal for every transaction. The situation in India revealed similar patterns. Mumbai gold dealers opened their shops on January 29th to find international headlines screaming about a precious metals collapse. Their phones started ringing with questions from nervous customers asking if they should sell their jewelry and family holdings. The dealers checked their wholesale networks. They contacted their suppliers. They reviewed actual bid-ask spreads in the physical market. And they told their customers the same thing. Nothing had changed. Wholesale dealers were still buying gold at $2,559 per ounce. They weren't lowering their bids. They weren't refusing inventory. They weren't showing any signs of panic whatsoever. India represents the world's second largest gold consumer market. Wedding season was approaching. Festival buying patterns were beginning. Cultural demand for physical gold jewelry, coins, and bars operates independently of Western financial market sentiment. Indian buyers don't check COMEX futures before purchasing gold for their daughter's wedding. They don't care what algorithmic traders in New York are doing. They care about the actual price that physical dealers will accept for real metal, and that price hadn't moved. And one prominent Mumbai dealer later described the situation in remarkably blunt terms. When asked if he considered lowering his buying prices to match New York's crashed levels, he simply laughed. Why would I pay less when my suppliers aren't charging less? The metal didn't get cheaper, only the paper got cheaper. That sentence captured the entire divergence in one observation. The Middle East provided the third leg of evidence that physical markets were rejecting New York's narrative. Central banks across the Gulf states had been steadily accumulating gold reserves for several years. The strategy reflected a deliberate diversification away from dollar-denominated assets and toward tangible reserves that couldn't be frozen or sanctioned. These weren't retail investors prone to panic. These were sovereign wealth funds managing hundreds of billions in assets with professional teams analyzing every market movement. On January 29th, not a single Gulf state central bank issued statements about reducing gold allocations. No emergency meetings were called. No strategy revisions were announced. Their silence was deafening. If sophisticated institutional buyers truly believed gold's value had permanently dropped, they would adjust their portfolios accordingly. They would take profits. They would rebalance into other assets. They did nothing, because they recognized manipulation when they saw it. The retail physical market provided perhaps the most telling test of all. Across the United States, coin dealers and bullion shops faced a straightforward question on January 29th. If the futures market said gold dropped to $2,200, would they lower their buying prices for customer coins and bars? The answer varied by dealer, but a pattern emerged. Approximately half of surveyed dealers didn't change their buy prices at all. They continued offering within $20 of the previous day's levels. Their reasoning was simple. They knew they could immediately resell any inventory they purchased at prices far above the crashed futures quotes. The other half lowered their bids slightly, but nowhere near the full amount of the futures crash. They might have dropped their offers by $50 to $70 while the paper market fell $300. Why not drop the full amount if the market had truly crashed? Because they knew something retail sellers didn't. The wholesale market hadn't crashed. Large refiners and institutional buyers were still bidding at near previous levels. The dealers who maintained relationships with these wholesale networks understood that the COMEX price was theater. The real market, the market where actual metal changes hands, that market was holding firm. One Texas dealer reported something particularly revealing. A customer walked in with $500,000 worth of gold wanting to liquidate after seeing the crash headlines. The dealer offered to buy it at $2,400 per ounce, $100 below the pre-crash level, but $200 above the crashed futures price. The customer was outraged. He demanded to know why the dealer wouldn't match COMEX prices. The dealer's response was perfect. Because I'm buying real gold, not paper contracts, and real gold didn't crash. The customer left without selling. 3 hours later, he returned and accepted the dealer's original offer. Because he had called 10 other dealers and received similar quotes from all of them. The physical market was holding a line that the paper market had crossed, and that line represented something more significant than just price levels. It represented a credibility threshold. Physical market participants worldwide were collectively deciding that New York's price discovery mechanism had lost legitimacy. They were choosing to ignore paper market signals and instead trust their own supply chains, their own networks, and their own assessment of actual metal availability. This wasn't a temporary dislocation that would resolve in days. This was a structural fracture in how global precious metals markets operate. And fractures don't heal, they widen. When markets break, they rarely announce it with sirens and flashing lights. The breakdown happens quietly, subtly, in ways that only become obvious months or years later when looking back. January 29th, 2026 may represent one of those quiet breaking points. For business leaders, corporate treasurers, and entrepreneurs building wealth outside traditional employment, the divergence between paper and physical precious metals markets carries implications that extend far beyond gold and silver prices. It signals something deeper about the reliability of financial infrastructure itself. Consider the position of a multinational corporation with significant currency exposure. Perhaps they manufacture electronics in Asia, sell products in Europe, and report earnings in US dollars. Managing this exposure requires hedging strategies that depend on one fundamental assumption. Markets must accurately reflect reality. When a treasurer executes a hedge using futures contracts, they're trusting that the futures price represents genuine market consensus about an asset's value. They're assuming that if they need to exit that position, they can do so at a price that correlates with the underlying physical asset. The January 29th divergence shattered that assumption. A company that hedged precious metals exposure through COMEX futures discovered that their hedge bore no relationship to actual physical metal costs. If they needed to acquire real silver for manufacturing, the futures price was irrelevant. Their suppliers weren't offering discounts based on crashed paper markets. The hedging instrument had decoupled from the asset it was supposed to hedge. This creates a profound problem for financial planning. CFOs build budgets based on forward price curves. They model production costs, using futures markets as reference points. They present board members with financial projections that assume market prices reflect obtainable transaction prices. When paper markets diverge from physical reality, all of those models break. A solar panel manufacturer budgeting silver costs for 2026 production faced an impossible question in late January. Should they trust COMEX futures suggesting lower input costs, or should they trust their actual supplier quotes that remained elevated? The wrong choice could mean millions in budget overruns or missed opportunities. This uncertainty represents a hidden tax on business operations. Companies must now dedicate resources to determining which price is real. They must maintain relationships with physical suppliers to verify actual availability. They can no longer simply check a futures quote and build a budget. The efficiency gains that global financial markets were supposed to provide, they're evaporating. For wealth preservation strategies, the implications are equally significant. Many affluent individuals hold precious metals exposure through exchange-traded funds, mutual funds, or other paper vehicles. These instruments promise to track gold and silver prices while offering the convenience of traditional brokerage accounts. But what exactly are they tracking? If paper prices diverge permanently from physical prices, ETF holders face an uncomfortable reality. Their shares may track the manipulated COMEX price, while physical metal trades at substantial premiums. The wealth preservation they thought they had achieved? It's an illusion. Several prominent wealth advisors began circulating revised guidance to clients in the weeks following January 29th. The message was consistent across multiple firms. Paper exposure to precious metals no longer provides the same protection as physical allocation. This shift carries practical complications. Physical gold and silver require secure storage, insurance, custody arrangements, authentication processes when buying or selling. Transaction costs are higher than simply clicking a button in a brokerage account. But those inconveniences may represent the actual cost of real protection. A business owner in Germany who allocated 10% of liquid assets to a gold ETF believed they had hedged against currency devaluation. When the divergence appeared, they discovered their ETF tracked the crashed paper price, while physical gold in German vaults maintained value. The hedge failed precisely when it was supposed to matter most. Regulatory risk adds another layer of concern that business leaders must now incorporate into planning. Executive Order 1.346 demonstrated how quickly government policy can reshape market structures. The tariff exemptions in Annex 2 created the regulatory arbitrage that enabled the paper-physical divergence. That order was drafted and implemented within weeks. History provides context for how rapidly precious metals regulations can change. In 1933, Executive Order 6102 prohibited private gold ownership in the United States. Citizens were required to surrender their gold to the government at a fixed price. Refusal carried criminal penalties. The order was issued and enforced within months. In 1971, President Nixon unilaterally ended dollar convertibility to gold. The entire Bretton Woods monetary system collapsed over a single weekend. Contracts written assuming gold backing became worthless pieces of paper. No warning was given. No gradual transition occurred. These precedents remind business leaders that monetary system rules are not permanent. Governments facing fiscal stress have historically resorted to dramatic interventions in precious metals markets. Confiscation, price controls, export bans, mandatory sales, all have precedent. The current divergence may signal approaching stress levels that trigger such interventions. Smart business continuity planning now includes scenarios that once seemed far-fetched. What if physical gold ownership is restricted? What if cross-border precious metals movements are banned? What if paper contracts are forcibly settled at government-determined prices? These aren't conspiracy theories. They're historical precedents being considered by professional risk managers. The larger economic signal embedded in the January 29th event transcends precious metals entirely. When coordinated market interventions occur, when prices are clearly manipulated, when regulatory structures enable divergence from reality, these patterns indicate systemic stress. Healthy economic systems don't require constant intervention to maintain stability. Prices discover themselves through genuine supply and demand. Markets clear naturally. Arbitrage opportunities close quickly. But systems under strain require increasing levels of management. Control mechanisms multiply. Official narratives diverge from observable reality. The gap between what authorities say and what markets show widens steadily. January 29th widened that gap considerably. Business leaders watching these developments recognize the pattern from previous crisis periods. The months before 2008's collapse featured similar disconnects between official reassurances and market behavior. The period preceding currency crises in emerging markets showed comparable divergences between official exchange rates and black market prices. These disconnects serve as early warning systems for those paying attention. The strategic framework for decision makers becomes clear. Physical allocation of precious metals provides different protection than paper instruments. The inconvenience is now the point, because inconvenient assets can't be manipulated with algorithmic trading. Counterparty risk in financial instruments deserves renewed scrutiny. Any investment requiring someone else's promise to perform carries risks that may materialize during stress periods. Alternative pricing benchmarks merit attention. If COMEX loses credibility as a price discovery mechanism, business leaders need to know which markets provide reliable signals. Shanghai, Dubai, and Zurich. Physical markets may become more relevant reference points than New York futures. Scenario planning must include monetary system instability, the assumption that dollars, euros, and other major currencies will maintain stable purchasing power. That assumption requires testing. January 29th wasn't the beginning of precious metals manipulation. It's been occurring for decades, but it may have been the moment when the manipulation became too obvious to ignore. When physical markets worldwide collectively reject paper market prices, when $300 gaps persist for hours, when wholesale dealers refuse to acknowledge futures quotes, the system has fractured. And fractured systems don't repair themselves. They eventually break completely. For business professionals who spent careers navigating economic cycles, building enterprises, and protecting accumulated wealth, the message is unavoidable. The rules are changing. The comfortable assumptions about how markets function, those assumptions are being tested, and the tests are accelerating. What happens next depends on whether physical market participants continue rejecting paper prices. If the divergence persists, two separate markets will emerge. One for people trading contracts, another for people transacting real metal. History suggests which market survives long term, because in the end, reality always wins. Paper promises eventually face a moment when someone demands actual delivery. And when that moment arrives, the institutions that sold what they didn't have, they face a choice: deliver the metal, or admit they never had it. January 29th may have been the day the bluff was called. The response from physical markets worldwide suggests they're no longer willing to play along. For business leaders watching carefully, that response provides the clearest signal available about what's coming. Preparation isn't paranoia, it's prudence.